Welcome to the MoneyWise YouTube channel. In this video, I'm going to explain how you can invest like one of the greatest investors of all time, Warren Buffett. If you're interested in building wealth and want to know how to grow your money smartly, you're in the right place. Let's talk about some of the investment principles Warren Buffett has applied to build his fortune. So stay tuned. What makes Warren Buffett a successful investor? Warren Buffett is known as the Oracle of Omaha. He's one of the richest people in the world and built his fortune by making smart, patient, and well-researched investments. So what makes him so successful? The answer lies in his investment strategy. He focuses on long-term growth, follows a disciplined approach, and does deep research on the companies he invests in. Principle 1. Patience. Long-term investing. The first principle we can learn from Buffett is the importance of time. Warren Buffett often says, "The best time to invest was 20 years ago. The second best time is today." What does he mean by that? Simply put, the longer your money is in the market, the more it has a chance to grow through the power of compound interest. Buffett didn't build his fortune by chasing quick profits. He did it by investing in quality businesses over many years. What does this mean for you as a beginner? Start investing today, even if it's in small amounts. It's not about getting rich quickly, but about letting your wealth grow over the long term. Principle 2. Index funds, a simple and safe strategy. One of the simplest and most intelligent ways to invest, according to Buffett, is by investing in index funds. These are investment funds that track the performance of the entire market, like the S&P 500. By investing in index funds, you're buying a small piece of the largest companies in the US, which provides diversification and reduces risk. Buffett himself often advises investing in low-cost index funds for people who don't have the time or knowledge to analyze individual stocks. For most people, this is an excellent way to benefit from market growth without worrying about picking the right stocks. Principle 3. Individual stocks, choosing companies with a sustainable advantage. Of course, besides index funds, Buffett also invests in individual stocks, but with a specific strategy. He looks for companies with a sustainable competitive advantage, or what he calls an economic moat. This means the companies he chooses have a lasting edge, such as a strong brand, unique technology, or dominant market position. For you as a new investor, it's important to understand that picking individual stocks requires patience and research. You need to find companies you believe will continue to grow in the future, even when the economy fluctuates. This means looking at the company's strategy, management, and how they handle changes in the market. Principle 4. Dollar cost averaging, investing regularly without worrying about the market. Another strategy you can use is dollar cost averaging. This is a method of investing where you regularly invest a fixed amount of money, regardless of the market price. By doing this, you buy more shares when the price is low and fewer shares when the price is high. Over time, this can lower your average purchase price and help you avoid the stress of trying to time the market. Buffett himself has applied this principle. It's not about guessing when to buy or sell, but about consistently investing, regardless of market conditions. Principle 5. Compound interest. Let your money work for you. Finally, I want to talk about the power of compound interest. Warren Buffett always says, compound interest is the eighth wonder of the world. What he means is that the longer your investments sit, the more they work for you. Interest on interest means you not only make a profit on your initial investment, but also on the profit that investment has generated. As of the end of July 2024, the average annual return of the S&P 500 over the past 100 years is 10.6%, assuming dividends are reinvested. This means that if you had invested $300 every month for the past 35 years, your investment would be worth over $1 million today. Of that amount, only $126,000 would be your own contributions, while $938,000 would come from the returns. This is the power of patience and allowing your wealth to grow over time. If you start investing and keep your money invested for the long term, compound interest will help your wealth grow exponentially. Conclusion: how to start today. So, what can you do now to start investing like Warren Buffett? Here are a few steps you can follow. 1. Start investing today, no matter how small your investment is. Patience is key. 2. Consider starting with index funds for a safe and simple way to invest. 3. Look for companies with a sustainable competitive advantage if you decide to buy individual stocks. 4. Use dollar cost averaging to invest regularly without worrying about market fluctuations. 5. Let the power of compound interest help grow your wealth over the long term. Investing is a marathon, not a sprint. If you follow these principles, you'll be on your way to reaching your financial goals. If you found this video helpful, make sure to like, comment, and subscribe to MoneyWise for more insights on how to manage your finances and grow your wealth. Thanks for watching, and I'll see you in the next video.